Thank you very much for the kind introduction, Victor. I think it's fair to say that COVID-19 has increased the volatility of asset prices and uncertainty about the future. As a result, disagreements about value, which is based on expectations about the future, have increased because of COVID-19. In particular, disagreements about the future and therefore divergent views on value between buyers and sellers of companies have been exacerbated. These disagreements have led and are expected to continue to lead to post-M&A disputes. In this presentation, I'm going to talk about post-M&A disputes with a focus on valuation and highlight a number of areas where COVID-19 would affect these valuation disputes. This will be relatively high level because of time, but if there are any questions, please send them through and I will try to answer them at the end of this talk. So, post-M&A disputes are caused by disagreements between buyer and seller. I will focus in this presentation on buyers and sellers of companies. M&A disputes can be categorized as pre-closing or post-closing disputes. Pre-closing disputes, there's a failure to complete. We're generally talking about the buyer seeking to pull out of the deal, but it could also be the seller. And this could be caused by force majeure, or material adverse change clauses being triggered, failure of the buyer to obtain funding, regulatory issues, and failure of the seller to meet pre-closing conditions, for example, breaching operating covenants. Post-closing disputes can be caused by breaches of representations or warranties. As a reminder, the seller's representations in an SPA are generally statements about past or existing facts about the target company. Their purpose being to guarantee the accuracy of the information provided by the seller about the target company's financial and operational status as at the date of closing. The seller's warranties, on the other hand, are generally forward-looking promises about the performance of the target company, their purpose being to guarantee a certain level of future performance. Second causes of post-closing disputes are fraud or failure to disclose. So, such claims are generally based on the seller intentionally concealing critical information from the buyer during pre-contractual negotiations, which, if disclosed, would have had a significant impact on the buyer's valuation of the target company. The claim for fraud offers a route to disapply any limitation or cap on the seller's liability for breaches of warranty. Also, it can offer the buyer a way to exit the transaction by rescinding the SPA and being restored to its original position. Third cause is completion adjustments disputes. These are adjustments to the purchase price between the SPA date and the completion date. For example, a transaction may be predicated on a set of accounts at, say, 31st of December, but the closing date is, say, 31st of March. Therefore, a mechanism for adjusting the accounts between those two dates may be necessary. Sometimes this leads to a dispute on how to adjust the accounts, especially when there are large or unexpected changes between the set of accounts. And finally, earn-out disputes. Earn-outs are where part of the purchase price is contingent on the future performance of the target company after the acquisition. Disputes arise about whether the thresholds of the metric or metrics on which the earn-outs depend have been reached, and on the calculation of those metrics. Now, what makes post-M&A disputes more likely to happen? Mainly uncertainty and volatility, whether economic, market, or regulatory. An SPA is agreed at a set point in time, even when with mechanisms that allow for some flexibility, such as completion accounts. When the background is uncertain and there is added volatility in economic or market conditions, then it increases the chances of a transaction which was a mutually good bargain to end up being a bad deal for at least one of the parties. A buyer pulling out is harder to replace due to lower market demand in volatile conditions. Completion accounts are harder to compute because more estimates are required or the estimates are more difficult to agree between buyer and seller. And whether or not warranties are breached becomes harder to assess. The second factor is time. The longer it takes to complete the transaction, the more time there is for such things as force majeure or material adverse change clauses to be triggered, or for regulations to change. As such, COVID-19 has led and will continue to lead to more post-M&A disputes, not only because it has increased uncertainty and volatility, making estimates more difficult and controversial, but also because COVID-19 has led to restrictions on operating purchase businesses. Think, for example, of the transport and hospitality sectors. So previously agreed earn-out thresholds are now unrealistic, and COVID-19 makes it more difficult to market a business for sale after a deal has failed. The post-M&A valuation disputes I'm going to focus on in this presentation are valuation issues in case of failure to complete the transaction and diminution in value claims in post-closing disputes, in this case related to breaches of representations or warranties. So starting with valuation issues in case of failure to complete. The purchaser has failed to close the transaction and the contract has been terminated. What is the seller's loss? The general approach to calculating losses is to assess the difference between first the counterfactual position the seller would have been in had the transaction closed as envisaged by the SPA, that's often called the but-for scenario, and second, the position the seller is actually in, it's the actual situation. Now, the counterfactual scenario, unusually in disputes, is more straightforward than the actual situation because we have an SPA that sets out the purchase price. However, if the SPA includes a purchase price adjustment based on completion accounts rather than a locked box mechanism, there will be an adjustment for closing accounts. There may also be an earn-out to assess, which will be based on estimates. So the but-for scenario may not be as simple as it first appears. Now, the actual situation, in the simplest cases, the seller finds another buyer, presumably at a lower price. So the loss would be the difference between the original SPA price and the new sale price. There may be questions about whether the new sale price is the best that the seller could have obtained. In particular, if the seller has a duty to mitigate its loss under the relevant law. There will also be questions about the date of loss assessment. In particular, if the original SPA or the new sale contract contain completion adjustments or earnouts, in which case neither of the sale prices would be known for a while. While the date of breach can be considered to be either the date of termination of the SPA or the stated closing date, it's not correct to assume that this is the date at which the actual value of the business should always be assessed. More on that in a minute. The value in the actual situation could be more complicated still if the seller cannot find another buyer. So the value of the target company would need to be assessed assuming typically willing buyers and willing sellers, even if there are no willing buyers. Now that does not mean that the target company is not worth anything. The seller and the original buyer took some time to negotiate the SPA. So a period of marketing, due diligence, and negotiations would need to be assumed. In the meantime, the seller is still in possession of this business. So at a minimum, you would need to consider the value of the target company retained by the seller. This is akin to estimating a value in use for financial reporting purposes. The appropriate valuation method would likely be a discounted cash flow, or DCF, in which the future cash flows to be generated by the target company as part of the seller's business or as run by the seller are forecast, and then discounted to a present value to take into account the time value of money and the risks inherent in those forecasts. There will be debates between buyer and seller about the forecasts, as the seller will have an incentive to make them as conservative as possible, and the opposite for the buyer. Now, the past cash flows of the target company would be a good starting point. And also, remember, a lot of information would have been collected for the due diligence of the buyer, including potentially some presumably optimistic forecasts prepared by the seller. So this information will be useful to forecast the future cash flows of the target company in the actual situation. There will also be debates about the date of valuation, and in particular, about whether hindsight can be used in the actual situation. That is, whether information that only became available after the date of breach can be used in the valuation. Now, hindsight is often a contentious issue in valuation disputes, but that is typically in respect of the counterfactual scenario rather than the actual situation. Let's move to valuation issues in case of breach of warranties or representations. In this case, the transaction has completed, and the buyer claims that the seller has breached its representations or warranties. Let's also assume that the buyer does not claim the reversal of the transaction, but claims that the price it would have been prepared to pay but for the breaches would have been lower than the SPA price. Now, in practical terms, damages would be assessed as a diminution in value. That is the difference between the SPA price and the price that the buyer and seller would have agreed had the seller not breached the SPA. The question becomes, how does the breach impact value, which is assumed to be, but is not necessarily the same as asking, how would knowledge of the breach have affected the price that the buyer was willing to pay? Now, typically in an M&A transaction, the buyer and seller would value the target company using a number of valuation methods. As I said earlier, the value of a business is a function of the profits or cash flows that this business will generate in the future. So the valuation of the target company will entail preparing forecasts. The buyer and seller will then negotiate the price and terms of the SPA. They may discuss the target company's forecast in detail, and they may also review comparable companies and transactions in the sector. However, in the end, and more importantly in the SPA, the agreed price will be a negotiated figure, and it will likely not correspond to any of the valuation models or scenarios prepared by the buyer or seller. Also, for simplicity, the agreed price may be expressed as a multiple of a historical metric, say a multiple of the last 12 months EBITDA, say 8 times EBITDA, even if the price was not arrived at by multiplying the last 12 months EBITDA by 8. Now, in principle, this metric, EBITDA in this example, has to be representative of future maintainable earnings. So it must not include the impact of one-off or exceptional non-recurring items. Sometimes this is forgotten by the time the SPA is finalized. Let's have a look at an example. What is the impact on value of the breach if the breach is under provisioning for bad debt? Now, the buyer will say that the bad debt provision should have been £1 million higher. So the EBITDA should have been £1 million lower. This means that the purchase price I would have been prepared to pay would have been 8 times that, so £8 million lower. That is my loss. The seller will say that the bad debt provision was only understated for the last 12 months because of an exceptional issue with a particular customer. So going forward, the bad debt provision would return to its normal level, which was the level assumed in the SPA. In other words, the adjustment to be made to the SPA price is for £1 million, not 8. Now here, a mix of investigation and valuation skills will be needed to understand the most likely impact of the breach on the valuation and then on the purchase price that would have been agreed. COVID-19, of course, complicates these typical post-M&A disputes because, taking our example, it becomes harder to gauge whether a breach of warranty has a one-off or permanent impact. Is the impact of COVID-19 itself a one-off shock, long-lasting or permanent? It's a challenging question. More generally, the increased uncertainty and volatility mean that future cash flows will be harder to forecast. And the risks attached to these cash flows, that is the discount rate in a DCF valuation, will become more contentious. And if you're using multiples valuations, historical transactions may not be representative of the current market, and listed comparable company multiples may not fully reflect the impact of COVID-19 due to the lag in availability of results. Many other issues that will cause M&A valuation disputes are impacted by COVID-19, and I have not had the time to cover them in this presentation. They include fraud and failure to disclose. Now, these can be tied to issues we've already discussed, such as the impact of breaches of representations of warranties. And finally, earnouts. Now, they're often a contentious area due to poorly defined metrics, and these are made worse by COVID-19. For example, do those metrics include or exclude government support? Secondly, uncertainties over the timing of meeting targets. So should we allow or not time to recover from COVID-19 and or from the government restrictions? And thirdly, the scope of any restrictions on the target or the buyer's ability to take certain steps during the earn-out period that could influence whether the earn-out is realized and its quantum. Hopefully, this has given you all food for thought. Thank you very much for listening and take good care.